Okay, thanks for coming and welcome to my first ever full-day seminar focusing exclusively on the Forex markets. And congratulations on signing up early. As you may know or may not know, the seminar sold out within 2 weeks. And in fact, we still have a crowd waiting outside to get in, but they've been there a long time. Look at the hats. So Forex trading has become one of the most popular forms of trading recently. It's interesting, and it's actually, there's lots of reasons why the 24-hour market, few markets to monitor. I mean, think about it in equities, how many thousands of stocks are there, but in the Forex is few crosses or pairs. The leverage, and the highest amount or percentage of speculators are in the Forex market. I've heard statistics, something like 90% of the Forex market is speculation. And the standard chart in Forex trading and currency trading is the candlestick chart. But most people don't know how to use them, or even better for you, people misuse them. They think they know how to use them. And one of the goals today is showing you some of the misuses of candles. How many are new to candlesticks here? Okay. How many trade intraday? Okay, usually it's at least half on the Forex side. Swing trading, in other words, from a day to 2 weeks, should be probably the rest of you. Anybody do anything longer term in Forex? No. That's why the candles are absolutely perfect for Forex trading. Candlesticks, and by the way, I use the word candles and candlesticks interchangeably. My website is candlecharts.com. And candlesticks are really geared for short-term trading, including intraday to swing trading. In other words, anything from a day to a couple of weeks. Interesting how the candlesticks have become so popular in the Forex market now. When I started to do the research in the candles in 1989, well, actually my first book came out in 1989 BC, and of course we know BC means before candlesticks. At 2 in the morning, that's going to be really, really funny. But when I started to do my research in the 1980s, I was on the future side. I used to work for E.F. Hutton and Merrill Lynch, and my job was giving trade recommendations over what back then, I don't know if it's still around, it's called the hoot and holler. Essentially, I'd be in New York, and I'd pick up a phone, and all the commodity offices within the U.S. would have an open phone line, essentially just a speaker, and they would hear my trade recommendations. And the most technically savvy traders in the 80s were futures traders, because back then it was really the only market that had really high volatility. I mean, think about equities in the 1980s, right? Equities were on par with bonds. No plain words there, par and bonds. But they were both very relatively conservative trading vehicles as far as speculation is concerned. So the most technically sophisticated analysts, as far as technical analysis was concerned, are on the futures side. And they were the first to pick up the candlesticks, because a lot of futures traders were in and out very, very quickly. Then, during the bull market in the 90s, when day trading became very popular, speculation became very popular, the candles really picked up steam at that point. And now, the same thing with the Forex market. And I've done many, many seminars. Most of my work has been for doing on-site seminars for institutional clients, Fidelity, Goldman Sachs, JP Morgan, Morgan Stanley, the list goes on and on. Money managers, hedge funds, market makers, and so forth. And also in that group were Forex traders. And I especially did a lot of seminars pre-Euro, okay, when there were a lot of Forex trading shops around, Deutschmark and all that when that was trading. And I still do quite a bit of seminars for Forex trading shops. And everything I'll be doing today can be is especially geared to the Forex market. Now, some of you may be aware I'm the author of a few books on candlesticks. Okay, 3 books actually. So far, they've sold over 100,000 copies. And I tell people, if you ever think of writing a book for money, don't do it. It's really good for your reputation. I would suggest if you're in an industry where you want to get your name out, write a book, because then they get see author of, as though that means anything, right? It's like you go to a store and it says, as seen on TV. Why does that make it more credible? You pay a few bucks and you have an advertisement on TV, as seen on TV. But for some reason, it helps your reputation. And speaking of books, just to let you know, all my newest information over the last, I'd say 5 years, is revealed only in my live seminars or my DVD workshops, which are taken from my live seminars. When I was doing my books, I was working at brokerage firms, so I had a salary. So everything I knew went into the books. Not that way anymore. So the books, I like to say, on a knowledge level from 1 to 10, will take you to about a 2 or a 3. But the strategies, the tips and tricks really are revealed only at my live seminars. What I'll be doing today is revealing many of the same strategies I teach to my institutional traders. What our shop does is we do on-site seminars, and we have a custom advisory service where our institutional clients would ask us specific markets for us to analyze on a daily basis. And the idea is you're going to be able to take away these trading strategies and apply them immediately on the next trading session. The goals here are twofold: to make this one of the most, I think it'll be one of the most important technical analysis seminars you'll ever have on Forex trading. And secondly, to make it as entertaining as possible. Okay, as I mentioned, most of my seminars are given for institutional traders, and I do them at the end of the day when they're really tired, 4:30, 5 o'clock. So I had better make them not only informative, so they have me back year after year, but interesting. So we'll be using a lot of cartoons. I have custom-made cartoons, Japanese proverbs. After all, these are Japanese candlestick charts. Humor. Some of you may laugh at my jokes. Some of you may not. And there's a great, speaking of proverbs and humor, there's a wonderful Japanese proverb, and it says about somebody laughing. He's laughing so hard. It's they say to boil tea with one's navel. And you have to think about it. He's laughing so hard, his belly button is moving so fast, he's boiling tea. He or she is boiling tea. I think that's a wonderful proverb. Now, I had mentioned before, for those who have my first book, Japanese Candlestick Charting Techniques, you'll know at the beginning of each book I have a proverb. And believe me, it took me a long time to get all these proverbs. I had books translated. I had 13 books translated from Japanese to English, and also proverb books. And in fact, speaking of translations, I had alluded to the fact that people are misusing the candlesticks. And this is twofold. This is for people who have not read about the candles, and even for people who've read about the candles. There's a lot of misinformation out there. And it's a real credit to you that you've taken the time and effort to come here to learn how to correctly use it. Because if you think about it, I am the only one, first of all, since I'm the one who revealed candles to the Western world, okay, I'm the source of all the candlestick information. If you look at the back of my books, my first 2 books, you'll see anywhere, it's been so long since I looked at one of my books, anywhere from 10 to 15 Japanese books. I'm the only one who has the source material. And all the other books out there use my book as a reference. I had to actually threaten a few of them to at least acknowledge that. They don't like to do that. But look at the back of their books, their information, and you won't see any Japanese books. I spent years and years of research uncovering what I call these secrets of the Orient. It took me about a year to, first of all, I found a translator, and I wrote a little article in Futures Magazine in the 1980s. And there was so much, a one-page article, I think, and there was so much interest in the candles at that point that I said I have to do more research. And the trade recommendations were working out so well. When I was doing the trade recommendations back in the 80s, when I was doing the initial research on the candlesticks, I didn't let the commodity brokers out there know that I was using candlesticks because I was still doing research. And the trades were working out so well, it really gave me the incentive to continue to pursue the information, and it was a lot of work. As I started to say, it took about a year to have somebody translate all the books, about 13 books, and then it took me about a year for me to translate his translations. The Japanese do everything by metaphors and analogy. So I had to learn about Japanese history, about Japanese military culture, like the samurai, and we'll be making a lot of references to samurai and military history today, and then about another year to write my book. So my great concern was when I was writing the book, I would go, and the book was done, I would go into the bookstore, and I would go to Barnes & Noble and be in the books for a buck bin, you know. So luckily, that has not been the case. So what we're going to do today is go over, as I mentioned before, some of my favorite candlestick and Western indicators. We'll talk a little bit about money management. That's not really the focus here. There's other avenues, educational resources, but we will definitely touch on money management because it's such a vital component. And one very important aspect, and the reason I'm so pleased to have you here, is I really want you to ask questions. The way you're going to get the most information out of this seminar, the way we're going to learn from each other, is ask questions. Okay, this is very interactive. The Japanese say questions are the wick in the candle of learning. We're also going to have hundreds of real-world examples. You have this handout. Okay. And we're going to go step by step. The Japanese proverb says, the fool in a hurry drinks tea with chopsticks. Okay. We're going to go over this step by step. That's why you have this voluminous handout. And the way I like to visualize this actually is the information is going to come out like gushing from a fire hydrant. Okay, this is your bucket to catch the information. So let's look at what we're going to be doing today, an overview. First, we'll be going over the construction of the candlestick charts. I had asked you how many are new to candles. I guess the question is, how many use bar charts now? How many still use bar charts? Nobody. Okay, I'm not surprised. Every time I ask that, there are fewer and fewer people because people realize the information they get with a candlestick chart can't be received any other way. And for those new to candles, I want to make sure we all understand how to draw the basic candlestick line. So we'll be going over that during the session today. We're going to look at individual candlestick lines. You'll be amazed with how much information you get with one candlestick line. You're going to see how the candles relay the imbalance between the bulls and the bears. Then we're going to progress and look at candlestick patterns, and that is more than one candlestick line. Most of the candlestick signals are made by more than one candlestick line. We're going to look at the differences between Forex and non-Forex candle signals. I get many emails asking about my resources, my DVDs and so forth, and they ask, can they be used in the Forex market? And the answer is yes. The only thing that can't be used are gaps, okay, what the Japanese call windows. However, although all the patterns can be used in the Forex market, what we're going to do today is show you how those patterns are a little bit different because the Forex market is a 24-hour market. Blueprint for Forex trading success. And what we're going to do that in this, which will be later this afternoon, is kind of bring together how to use the candlestick signals so you can apply them in real-world trading strategies. So for example, we're going to show how to combine candlesticks with Western indicators. Now, I've talked about Western indicators before in my other seminars, but I'm going to be looking more today on what is important in the Forex market. For example, Fibonacci retracements. Very important in Forex. I don't talk about it when I do seminars for equities. So we'll look at East and West. Then we're going to be looking at intraday candles. Since so many of you are intraday traders, we're going to look at techniques that will help refine entry and exits on the intraday. Even for those who are not intraday traders, for swing traders, hold positions more than a day, I'm going to show you some really neat techniques for using intraday signals to get earlier buy or sell signals that you don't see on a daily chart. So for those who are intraday, certainly this is going to be important for you, but don't tune out if you're a swing trader. I'm going to show you some really neat things that you can apply to improve timing, entering and exiting the markets, things you may have never thought about before. Money management. Okay, this is one of the greatest misuses of candlesticks. People forget about risk-reward analysis, adapting to the market, looking at the candles in context. Again, we'll be going through all this during the seminar. Okay, trading psychology, we'll touch on this also. Okay, you can have all the tools, but if you don't have the right psychology, the tools are not going to do you any good. And that's a real challenge to many, many traders. And we're going to have what I call the candlestick screener. Okay, a lot of this stuff is brand new, including this. Okay, a very valuable way to increase the odds of a trade working if the market's at support or resistance. By the conclusion of the seminar, let me tell you what you're going to be able to accomplish. You're going to be able to spot market turns ahead of the competition. This is what the candlesticks shine at, giving us reversal signals in 1, 2, or 3 sessions. You're also going to be able to know when to act on a candlestick signal and when to ignore a candlestick signal. Not every candlestick signal should be traded. This is a major mistake many traders make. They get so excited that they recognize a candlestick signal, that they buy or sell it. That's the easiest and best way to get burnt with the candles. You're also going to know which trades to avoid. Candlesticks excel at helping us evaluate probabilities. So we're going to look at analyzing the candlestick line or signal if the market makes a new high and low and be able to say to ourselves, well, the market broke resistance, but based on this candlestick signal, I don't think the rally is going to continue. Or if the market broke support based on this candlestick signal, I don't think the sell-off is going to continue. Knowing what not to do can be just as important as knowing what to do. And then we're going to be able to analyze, and this is something else people don't think of, and I bet many of you never thought of this. You could have a single candlestick signal, but at times you use that candlestick signal to exit a position. At other times, you should use that candlestick signal to enter a position. And there are ways to say, okay, I'm going to use the candlestick signal to initiate a new position. Other times you say, I'm only going to use this candlestick signal to exit. There's lots of material written on entering positions, very little material written on exiting. Okay, we're going to look at exit strategies today. So essentially, by the end of the seminar, you're going to be able to, as our slogan says, be able to trade smarter, trade better, trade safer. We're going to now look at the construction of the candlestick line. I know many of you are familiar with this, but without the Japanese say, without oars, you can't cross in a boat. These are your oars. If you have any questions, of course, during the seminar, feel free to interrupt and raise your hand. And especially this part, because everything we'll be doing for the rest of the session, including when we talk about Western technicals, are all going to be based on drawing the candlestick line. Very simple. The candlestick line is made of 4 data points. And the 2 data points that define the rectangular portion of the candlestick line, which is called the real body, is the open and the close. So the open and close is a relationship that forms the real body, whether the real body is black or white. A white real body means the close is higher than the open. By the way, you could use candlesticks in all time frames. I will personally look at daily, 30, and 60 minutes, but that's because I do my analysis at the end of the session, okay, for our institutional traders. For those who trade intraday, you could use 5, 10, 15-minute candles. Essentially, the time frame you should be using is dependent on your holding period. If you're going to hold an intraday trade for less than 2 hours, I would be looking at 5, 10-minute candlestick charts. If you're doing 2, 3 hours or a good portion of the day, I'd be looking at 15-minute, 30-minute, and 60-minute. But my focus, only because of the way I work, are daily candle charts, 60 and 30 minutes. And as I mentioned before, there are going to be ways, even if you trade with a daily chart, there are going to be reasons why you should be looking at 30 and 60-minute candles. We'll talk about that when we go to the intraday. You'll be able to find what we call hidden support or resistance areas that people who look at the daily charts may not be able to see. So we have a white real body because the close is higher than the open. A black real body means that the close is under the open. Now, most charting services, because of the Forex market, the opening closing, there's really no opening closing. Most charting services will use 5 p.m. Eastern time as the closing or opening. So, for example, it'll be 4:59 Eastern time, 4:59 and 59 seconds is the closing. The next trade is the opening. And it's this aspect about the Forex market that's different than the other markets that are going to be the reason why some of the candlestick signals are constructed a little differently, as we'll look at later. The lines above and below the real body are called the shadows. So we have the upper shadow and the lower shadow. The high of the upper shadow is the top of the session, and the bottom of the lower shadow is the low of the session. Now, I had mentioned some of the benefits you'll be walking away with at the end of the seminar. The early reversal signals, avoiding bad trades. You'll also be able to, and let me explain why, be able to combine candlesticks with your favorite Western charting techniques. And one of the things we'll be talking about today when we did the overview was candles and Western technicals. You know, I'm asked, Steve, if candles are so great, why Western technicals? Well, let me ask you this. What 4 data points do we need to make the candlestick line? Open, high, low, and close. What do we need to make a bar chart? Same thing. And this is really valuable, and this is why I'm able to do seminars for institutions. Whatever Western charting techniques you use, Fibonacci retracements, and I'll show these later on, moving averages, Bollinger Bands, trend lines. Obviously, we don't get volume in the Forex market, but for those who trade non-Forex, volume. Whatever you do in a bar chart, you do in a candlestick chart. But by adding the visual insights of the candles, which we'll be looking at later, if you get a candlestick signal confirming a Western signal, the probability of a trade working is much, much higher. And as I just said before, the reason I'm able to do seminars for institutional traders, I don't go in there saying, hey, use the candles instead of what you've been using over the last 10 years for your career. What I suggest is use this in addition to. And that's what I suggest to you. You may have your own favorite Western charting techniques. You may find a moving average works particularly well, an oscillator. Stay with it. Don't give it up. Add the candlesticks to it. This is a very, very powerful aspect of the candles. The lines to your right are called doji. And doji are sessions where the open and closing are the same. And doji, again because of the Forex, are going to be viewed a little bit differently than non-Forex. So before we move on, are there any questions about the construction of the candlestick line? Yes?
I have a question about the use of candlesticks on different platforms, because I've noticed that, like, if you have one data feed based on one bank, then you have, it's very clear that the close of one candle is equal to the open of another candle.
What I would suggest doing, and we're going to look at this in a couple of minutes, is don't be too critical about if one candlestick line is a doji and another one on another platform has it not quite a doji. And we'll look at that in a couple of minutes. Right? But essentially, I think it's really important if you're using a data source, most data sources close at 5 o'clock. I would really make sure it does that. Because most of the people who trade, the institutions, will have it closing at 5 o'clock in New York. Okay. Now, how can we use the candlestick lines? We're going to start looking at single candlestick lines. The Japanese will say the real body is the essence of the price movement. And that's a really exciting concept. Because what the candlestick line shows is the force behind the move. If we have a long white real body, who's in charge? The bulls, right. A long black real body, obviously the bears are in charge. Now, as the real body gets smaller and smaller, we wind up with what the Japanese call spinning tops. These are just small real bodies. And what's wonderful about the candlesticks is that they allow you to, they alert you to subtle changes in the markets, the supply-demand situation. So with the tall white candle, the bulls are in charge. The long black real body, the bears are in charge. As we get these diminutive real bodies, as shown here, it shows the market may be losing a little bit of force. Now, let me show you why, if you're trading with a bar chart, and it's to your credit that none of you are, but if you're trading with a bar chart, you're trading at a real disadvantage. Okay, here we have a chart, a bar chart, and based on this bar chart, the market looks fairly healthy. It's holding the highs very well. No reason for caution. Now, we take the same data as this bar chart and convert it into a candlestick chart. Remember, we use open, high, low, and close. See the different visual representation we're getting? Although the market's holding the highs very well, is it doing so with long white real bodies or with spinning tops and doji? Obviously the latter, correct? And what this is showing us is that the market may be losing some steam. And this is what unfolded after. Okay, obviously, it's not going to work that well every time, but what's really important about the candlesticks is that although it uses the same data as the bar chart, it shows us the price. The candles show us the price, correct? Like a bar chart does, but the power, the potency of the candlesticks is they also show us the force behind the move. That's the difference between a bar chart and a candlestick chart. I guess you could mentally convert a bar chart into a candlestick chart, but why bother, right? It's done on the charts for us now. Years ago, when I was doing research into the candles in the 80s, no charting systems had candlestick charts. I had to draw them all by hand. Okay, now all the charting packages have candlesticks. So this is what we're going to be looking at today, reading how to gauge what the candles tell us about the momentum of the market. So, although the market's descending here, in this blue circle, what's happening with the bearish control of the market? Gauged by the real bodies. What's happening with those real bodies in the blue circle? Getting smaller and smaller, exactly. Now, I don't know, I might be buying here because the market seems to be stabilizing. Normally, if we have, let me go back here, I would not be selling short here. As we progress in the seminar, we'll be talking about using candlesticks to initiate a new position as opposed to using candlesticks to offset a position. But based on this slide, I would not be shorting here. It's rare for me to recommend going counter-trend with a new trade based on a single candlestick line. Something like this I would use to lighten up on long positions. Move up stops. Take some profits. Now, getting to this slide, it's not so much the real bodies that are making me less bearish. I might actually think about buying here because just as you would on the bar chart, what's going on? What's happening to the lows? Right. You see, we're going from lower lows to the same lows, and then we're making higher lows. So the market's making a rounding bottom. And what's nice about this, although there are no specific candlestick signals, is we have a very clean-cut stop-out level. We'll talk about trading psychology a little bit later. There's not really a course in trading psychology, but my feeling is whenever you're going to place a trade, set a stop before you place the trade. That's when you're most objective. So it's the same information as the bar chart, but because it's drawn a little differently, we get volumes of more information, volumes and volumes of information that you just don't get with a bar chart. And sometimes a little difference, and that's all this is. It's the same data, but it's drawn differently. Sometimes a little difference makes a big change. So with that in mind, I have this slide. Okay, a different perspective changes the whole picture, and you're going to have to watch this as I progress. Okay. I'll go back. Some of us, it looks like a face, right? And now it doesn't look like a face. Different perspective. Now we're going to look at doji. Okay. A doji is when the opening and closing are the same. And doji are particularly potent at calling reversal signals. These are all representations of doji. And with the doji, the Japanese would say the market is tired. And it's often a turning point. Okay. Now, a lot of people misuse doji. Let me show you an example of one of the ways they may misuse it. Okay. First of all, who's in charge of the market during this ascent? The bulls, right? Anything different? Yes, the doji. Now, one of the ways people misuse the candles is they equate doji with sell short. Wrong. A doji means that the market has gone from up to neutral, not up to down. By being neutral, the odds of the turn have increased, but they're not 100%. To me, the odds of a turn are lower here than they would be over here. Okay, technical analysis, when using technicals, we're really trying to get the probabilities on our side. It's never going to be 100%. Okay, here is another small real body. Now, I want to show you this slide for a couple of reasons. First of all, to show that some charting packages will not have black and white for the candles, right? It might be white and blue. Another reason is that the red circled area, although it's not a perfect doji, see, because the opening and closing aren't exactly the same, especially in the Forex market, I would view it the same as a doji. And we'll look at why that's important in a minute or two. Yes?
Where's your confirmation of a market turn on that first doji?
Okay. The question is, it's a great question, where's the confirmation of a doji? And we can actually extend that question to the broad category of any candlestick signal. When is a candlestick signal confirmed? And we'll be looking at that as we move through the seminar, but especially when we talk about candles and Western technicals, if we see a candlestick signal confirming a Western signal, to me that would be a confirmation. But let's say we're only looking at the candles. When is a candlestick signal confirmed? What you could do is wait for the next session to confirm it. In other words, a close. Let's say here we have this doji, or a spinning top, and you wanted that extra confirmation. It would be either, I'm not sure if the close was lower here, but maybe this one, a lower close. The advantage of waiting for confirmation, so for example, when we talk about a particular candlestick signal that we'll be talking about later, like a hammer, you know, the hammer is the bottom reversal signal. Don't worry if you don't know it yet, we'll be getting to it. You could wait for the next session to confirm it either on the opening or the closing. But by doing that, you've increased the likelihood of the trade working out, right, because you've confirmed the candlestick signal. But if you're buying at a higher price, what have you done to your profit potential? You reduced your profit potential, exactly. So, yes, you can wait for the confirmation. By doing that, you've increased the odds of the trade working out, but you've also decreased your profit potential. If you don't wait for the confirmation, you've increased the profit potential, but you've decreased your percentage of being correct. It depends on your trading style. There's no right answer for that. But with the doji, I'm going to show you something in a minute. I can show you now. We'll talk about, don't worry about taking notes on this. But if for some reason you sell on this doji or the spinning top, you could set a stop. If the market gets above the high of the doji, it's a bullish breakout. And we'll look at that within a minute or two. Remember, there's always a price that says we're wrong. That's one great thing about charts. Very hard to do with the fundamentals. Okay. The highest percentage, easily the highest percentage of technical analysts are in the Forex market. There's no doubt about it. Because most is speculation. And secondly, think about it from a speculator's point of view. How, or especially intraday, how can you follow all the fundamentals? Right, between the interest rate relationships, politics, economics, and on and on. What's the easiest way at looking at all the fundamental news? Look at the price of the market. Look at the price of the chart. Now here we have a spinning top, and this brings us to the question about different data vendors. Okay. This is the same data. This is the euro, I believe. And two data vendors. And you can see one is a spinning top and one is a doji. So I would not be too exacting on saying, okay, this is a spinning top and this is a doji. I would view them the same way as long as the real body is very small. You know, we did a survey among FX traders, Forex traders, you know, what are they looking for from our company, Candlesticks.com. And one of them is, you know, he has a doji. Somebody says he has a doji in one platform and not a doji in another one. I would view these the same, exactly the same. And the reason that becomes important is because we could use doji, or in this case, spinning tops, as potential resistance. Before I talk about that, let me give you another difference between the doji in Forex and non-Forex. So first of all, one difference with the doji in Forex and non-Forex is that even if it's a spinning top, I would view it the same potential turning implications as a doji. Second one, this is non-Forex. This is a doji in the non-Forex market. The market closed here. It opened down here. And what happened by the end of the session? It held down there, right? Okay. In scenario 2, see, these are both doji following in a rally following a tall white candle. In scenario 2, what happened on the doji's opening? It gapped higher. And by the end of the session, the bulls had maintained the strength. So non-Forex, which is more likely a reversal? Scenario 1 or scenario 2? 1. Okay. Can we have this in Forex? Remember, scenario 1, what happened? The market gapped down. Scenario 2, gapped up. Can't have this in Forex. What we're going to have with the doji in Forex is this. The opening and closing are going to be the same, or a couple, maybe a pip or two difference. But these are going to be Forex in the, these are doji in the Forex market. Yes?
With the doji in Forex, being the difference is that there's no gaps, would it be better to see, as in scenario 1 and 2, where the second one had made a new high also?
Okay, the question is, if the intraday, although the doji, the opening and closing are going to be here, if during the session, whether it's a daily chart or an intraday chart, if intraday it pierces the high. Is that the question? Yes. Okay. One of my favorite charting techniques is if a market pierces a resistance area and can't hold above it, it's a great sell signal. Okay. If the market goes up here and then winds up closing down here and has to close down here to make the doji, I view that as a little bit negative, even if it's not a new high move for the close, because one of the great things about the candles, remember, it gives us that visual information about the psychology of the market, what's happening between the bulls and the bears. If the market, we'll look at shadows in a couple of minutes, but if the market has a long upper shadow here, what happened during the session? It had rallied there, right? Right. If the market was solid, what should have happened? It should have closed up there. So if it does this with this upper shadow, it's visually showing us the market's rejecting higher levels. I would view that. I would be more negative on this than I would be on this, because this has a bit of a lower shadow. Okay? We should always look at shadows as part of our analysis, which we will in a couple of minutes, but that's a great question. Okay, so these are doji and Forex. So here, for example, it's a doji. Well, obviously, it doesn't mean the market's going to fall out of bed like it did there. Okay, here we have a doji. Why do you think the odds of this doji calling a turn are higher than they would be without those blue lines? What are those blue lines? Resistance. Would you have those blue lines on the bar chart? Yes. Yeah. By the way, to make trend lines, angle trend lines, horizontal support or resistance, use the upper and lower shadows, just like you would on the bar chart, the highs and the lows. So remember what I said before, whatever you do in a bar chart, don't give it up. If you do, you're really giving up very valuable information. Although there's really no reason to use bar charts, in fact, it's dangerous. I mentioned before it's dangerous. That's very different than saying don't use bar charting techniques. So here we have a classic resistance area, and we have the doji confirming the resistance. This is the power of adding Western technicals to candles, which we'll be looking at in a lot of detail later on. Now, one of the questions that were asked is that how do we know a signal is false? Not every signal is going to work out. Candles are not perfect. What we could do is use the doji or the prior candle as a resistance area. So for example, what we do is we take the highest high, and this is going to get back to the question about making a high during the doji session, and use that as resistance based on the close. So for example, which of these two candle lines, we look at the doji and the immediately preceding candle line, which of these two candlestick lines has the higher high? Right. So that becomes resistance, our resistance area. As long as the market doesn't close above that, if you're short, you stay short. Normally, unless the candlestick signal confirms something else, I would use it to exit a position. But if you fundamentally, nothing wrong with looking at the fundamentals. If you're fundamentally bearish or you have other Western signals that say, hey, I want to sell short on the doji, that is your stop out level. Now, I'm going to extend the upper shadow. Okay, this is the question before. What happens if the upper shadow makes a new high? What we then do, which has the higher high, the doji or the prior candle? Which becomes resistance? The doji. This will help separate you from the competition. Remembering that we could use candlestick signals to use them as support or resistance. Okay, there's always a price that says we're wrong. A close above this high is telling us that we would be wrong if we're short. So, for example, I'll go back. Let me go back a couple of slides here, show you something really interesting. Okay. So the question before on this chart, this is back on slide 11, is how do we know for confirmation? What do we do for confirmation over here? Remember, a spinning top and a doji, I view the same thing on Forex. One of the options is wait for a lower close. The other option is if you don't want to do that, you set your stop out level. What's your stop out level? Up there. Yes?
For your stop level, do you want to go, in the forex market, do you want to go 5 pips above the high, 10 pips above the high?
Okay, the question is stop. I usually suggest anywhere from 10 to 20 pips. Be real careful around. The challenge with Forex is because it's so highly leveraged, and people use stops, and you really have to because of the leverage. That means the intermarket people, the dealers, the people who, the banks, they gun for the stops. And if you're, for example, by the zeros, it's normal retail to put a stop in at a zero. They may gun for the stops, and you get above it 5, 10, 15 pips, and then they're just going to turn around. So if you buy the zeros, I would probably give it 20 pips. It all depends on your risk-reward also. A vital concept is risk-reward analysis, and we're going to talk about that later in the session. But if you want kind of a rough ballpark, it would be that. Yes?
Also, you need to add the spread difference.
Yes, the spread difference, exactly.
If you say you want 5 pips above,
Right.
make sure you add the spread difference.
Yeah, that's a great point. Make sure the markets are mainly tight 2 or 3 pips, but if you trade some of the less active ones, you're going to increase the spread. That's a very good point. So, yeah.
Does that vary by the length of the session, candle? I mean, time frame of the candle?
The 10 to 20 pips, the question is, does the 10 to 20 pips stop at level vary according to the time frame? Meaning, if we're looking at a daily or an intraday, definitely. My feeling is, I just gave a rough ballpark, 10 to 20, because that's what a lot of the institutions will use. They'll use mainly daily charts. But I think it all is going to depend. I know it depends on your risk reward. If you're looking to make only 20 pips on the move, you're not going to, you're not going to give it 20 pips leeway. And actually, that'll be something good to focus on when we talk about the risk reward. How much leeway should we be giving? Okay, so let's move on. Okay, so now we've looked at using doji as a resistance area. So here we have the doji. As resistance, and this is one of the challenges. See how the market got above the resistance area but didn't close above it. Okay. Many of you are probably aware that the markets could get above resistance or below support on an intraday or, a daily or an intraday, and if it doesn't close above or below it, it's still valid. Okay. So that is why normally when I talk about a stop-out level, if you can risk it, we're talking about a close.
So can
When-
you say doji is used more for figuring out if the market is breaking up or down, rather than saying this is a reversal signal?
All right, the question is, can we use doji for saying the market is going to break up rather than a reversal signal? And the answer is yes. Spoken like a true politician. Reversal signal. The trend has gone from up to neutral. The odds of the turn have increased on this day as compared to this day. Okay, so we're using as potential reversal. And in that scenario, this is our stop-out level. Okay, I would normally not recommend selling on a doji unless it's confirming a resistance area or some Western signal. Getting back to the great question about can we use it as a continuation signal. Because we've now set a stop-out area based on the doji, what we've really done is also, for those who trade with momentum, which is a great way to trade, buying on breakouts, nothing wrong with that. You know, we're looking mainly at reversals, but you can use the candles for momentum. In this sense, if the market closes above the high of the doji, it's a bullish breakout. I would be thinking about buying. The Japanese say the market, with the doji, the market is tired. When the market breaks the resistance area, the market's refreshed. That's your buy point. I would, under no circumstances, buy in the doji. Okay, let the market prove to us that the bulls are in control of the market. How? By closing above the high of the doji. Here for another example, doji's resistance. Now this doji's resistance, now I've circled, in case you didn't see that, let me do it again on this slide here. I've circled that doji. And the reason I've circled that doji is to bring out a very important aspect. One of my Nissen trading principles, okay, I have about 18 Nissen trading principles. These are core trading principles, either how people misuse the candles or trading strategies, trading tips, and we're going to go through a few of them here. The number is not important, like 6 is not more important than number 5, or 1 is not important than number 2. As I mentioned, we'll go through a few of them here. We won't go through all of them, but one of them is that a candlestick line or signal requires 2 criteria. 1 is the shape of the candlestick line. 2 is the preceding trend. Okay, when I answered the gentleman's question before about using candles as reversals or momentum indicator, you know, most candles are mainly reversal signals. Okay, if the market breaks the resistance set by a candlestick signal, then you can shift into momentum. As a reversal signal, don't we need a trend to reverse? Exactly. So with that in mind, here we have a couple of doji. Now obviously in the Forex market, you're not going to have a doji gapping higher, so let's make the doji over here. Now the doji on your left, is it coming after a move, a rally? Is there a trend to reverse? Yes. The doji on your right, is that right? The doji on your right, is there a trend to reverse? No. It's in the middle of a trading range. Japanese call it a box range. And going back to the prior slide, that's what that red circle is all about. See the immediately preceding trend? And when I talk about the immediately preceding trend, I talk about the 2, 3, 4 candles before it. There was no trend to reverse. That doji has no turning implications. Yes?
So you would say it is in a
Right. Okay, so the question is, it's in the box
How do you determine?
here. Has the market been trading laterally for 3? The question is, how do I know it's in the box? We don't trade to the right. In other words, we don't know what's going on here. Okay. So we're at this point. What's the last 3, 4, 5 sessions? No trend. No trend. And the same thing here. Okay. The doji here at the green arrow, is that in the middle of a box range? Yes. Has no implications at all. There's no trend to reverse. And this is true with all the candlestick signals. We always have to think about the preceding trend. Over here, in this red circle. Now it's a spinning top, but once again, because it's Forex, to me it's the same as a doji. Is it still in the middle of a box range? No trading implications. However, I love trading box ranges. Why? Because we have clean-cut support and resistance. So, okay, isn't that doji in a trading range? Yes, but what's the difference? Where does that doji emerge? The top of the range. Was there immediately preceding trend? Yes. That's a great short sell. Because the market's confirming a resistance area. What was the little clue we had before the doji? A small real body, right? That's a great trading vehicle. So we're going to focus more on what I call candles in context as we look at applying the candlesticks specifically later in the session. But here you can see the doji. Although these are all doji in a box range, because one of these doji emerged at the top end of the box range, we react to it very differently than we would with a doji in the middle of a trading range. Okay, any questions on doji? We'll take a yes, and then we'll take a break.
You know, we look at a chart like, I don't know how many time frames this one is. See if you squish it, like, if you compress it, you get more data into it. So you can draw supportive trend lines, like, like in this case, if you're only looking at probably the right side of the,
Tell me when to stop.
if you look at the other way, you don't see the left side.
Right.
So you just see the right side. You could draw a box of range,
The question is, you can draw a box range anywhere. That's not really true. To get a box range, you need at least 2 or 3 highs that are the same, and you need 2 or 3 lows that are the same. So, for example, see? And then you have the lows over here. So what's going to happen is, let me go back here. See, I would view this as a box range like that. Okay. Okay.
Go back to the last one, the trading context. Okay. To me, it's easy to read the left side of the chart. It's the right side of the chart I have trouble with.
Right.
So on this last spinning top here, if I look at the high, this high looks like it is matching the long white candle.
This one?
Yeah, the last candle, the right side. That high looks like it's matching the long white candle to the left, right there. Right? So is that a range?
Okay, the question is, with this upper shadow here, it's confirming, okay, so we don't know about this stuff here.
We don't care.
Right, we don't care over there. Right. All right, so whoops. This is like a Picasso. When I'm looking at a chart, I'm not only going to look at 4 or 5 days worth of data. I go back at least 3 months of data. So I wouldn't be looking at just this action. Whoops. I would be looking at this action here. we just wouldn't be looking at this. There's no way I'd be looking at this amount, this little amount. These are daily charts, but it could be an intraday chart. So the question is, she's asking, is this a box range here if we're looking in this area that I made a red box around, and there's no way you should be trading with 5 days worth of data. My default is I usually go like 3 months, or whatever the equivalent is, really about 90 days, 60 to 90 days, or whatever the equivalent is on an intraday basis. Because if you go longer than that, if you have like many, many data points, the candles get really hard to see. Yeah. Go ahead.
Forex, you're not normally trading, you're normally trading days trades. Most of us trade days.
Okay, intraday.
Right. So, say this is
Actually, let's hold off on questions on intraday because we're going to have a whole section on intraday. Okay? And just hold off on that. Yes?
So regardless of what time frame you're looking at, the last 60 to 90
Period.
is that what you're saying?
Right. The question is, regardless of the time frame we're looking at, I would have at least 60 to 90 data points. For example, 2 or 3 months on the daily chart, whatever the equivalent is on an intraday chart. Now, the exception with that would be, what happens if, let's say we have 90 days worth of data, and this is our last data point. Why would I have to go back further than 90 days? To get a resistance area. In other words, this is the last part of our 90 days, I would go back further because we don't have where next resistance is going to be. Okay, so that's the exception. Or if there's a daily chart, I might look at a weekly chart. If this is an intraday chart, I might look at a daily chart. Okay. So why don't we take a 5-minute break now, and we'll then move on to shadows. And thanks for the great questions, and we'll be moving on. Okay, we're going to look at shadows now. As important as the real bodies are, shadows are very important. The Japanese say, like the right hand helping the left. So it is with real bodies and shadows. So here we have a candlestick line on the left that closed on the high. Now, if we have an upper shadow that offsets some of the bullish strength, the Japanese will say a long upper shadow suppresses the rallying strength. One upper shadow is not that big a deal, okay, except for a couple of candlestick lines. We'll look at hammers and shooting stars, but net, a single candlestick line is not that. A single shadow is not that important. Where they become important is if they're confirming a support or resistance area, because what's happening is if you have a series of long upper shadows right near the same resistance, if the market's strong, what should happen? It should close near the highs, right? If every time it gets to near a resistance area, it pulls back, it's visually showing us, and this is what the candles shine at, visually showing us what's going on between the bulls and the bears, the psychology of the market. The market's rejecting higher levels. So if there's a group of 2 or 3 long upper shadow candles near the same resistance area, I would certainly take notice of it. And this slide happens also to be what's happening with the real bodies. Smaller and smaller, right? Now here we have a couple of black real bodies. When you get our daily newsletter illuminations, you'll see that we have ST, short-term trend. ST, we abbreviate. So in this scenario, we would have, say this, this is the pound. We have these candle lines. The trend would be down. Short-term trend would be down. If we added these lower shadows, the short-term trend would be down neutral. They wouldn't be up. They wouldn't even be flat because it's mainly making higher closes. But this mitigates some of the bearishness. Okay, so we always have to look at shadows. So here, for example, we have a series of long lower shadows near the same support area. Time after time after time rejecting lower price levels. Same thing here. In fact, beside these upper shadows, what early indications did we have, even with the first few candle lines? Spinning top, doji, right? Now, during the break, somebody asked me about the spinning top and the doji, and we talked about how I view them the same. And the reason that becomes important is because, remember the rule that we had with the doji as a potential resistance area based on the close? All right. The same thing is true with the spinning top. I don't do this in equities or commodities or interest rates, only in Forex. If we have a small real body, a very small real body, because we view it the same as a doji in Forex, we could make a resistance area. Okay, this is exclusively Forex, so this would be resistance based on a close. If this was an equity, I don't use spinning tops as a resistance area. And some of you may recognize some of these signals. We'll look at this later. A bearish, the black wrapping around the white, a bearish engulfing pattern. There's an evening star variation. And we'll get to all these patterns in a couple of minutes. Yes?
How do you view that spike just to the right of the doji? Do you just disregard that, or is that...
Over this right here, the spike?
Well, the one to the left of it, but either one of them.
Okay, I'm not... So we have a resistance area. The question is, how do we look at the spike? And this spike?
Either that spike
Or the one before it. Okay, the question is, how do we view these spikes above the resistance area? And the answer is, did it close above resistance? No. So that doji is still a resistance area. But in the real world, you may not have been, if you were short on that doji or spinning top here, the only way I would be short on the spinning top is if it's confirming something else. But let's say you're short there. You have to be willing to risk on a close above here. We'll look at, a lot of the stuff I say we'll look at later, but I can touch on it now, is what you can do is, let's say you can't risk, having a stop on a close is almost like not having a stop. Correct? By the time the market closes above a resistance area, what if it closed on the highs here? Okay, this is the euro. Let's say it closed here, or let's say it closed all the way over here. And if you're short, you're going to hold into there? Probably not. What we're going to look at in a couple of minutes is using the concept of risk-reward, knowing what your risk or what your potential reward is, and then kind of going backwards and then using that to set your stop. So in other words, don't worry about, we'll look at one with specific numbers now. If you were short here, once again, let's say it confirms a resistance area, whether it's a Fibonacci retracement or a Bollinger Band or a high. Let's say your target is all the way down here. Okay, we have, again, for those more familiar, we'll go through this, a bullish engulfing pattern. If this is your target, that's a great target, and you're looking for, let's say, a 3-to-1 or 2-to-1 risk reward, you can then, you know what your target is, and then you could do, if you're looking at 2-to-1, you can do half that amount and set that as your intraday stop, because that's the most you're going to be able to risk to make it a 1-to-2 risk reward. And we'll look at some actual numbers on that. But there's a long answer to a short question. As long as the market doesn't close above this resistance area, it's still valid resistance. Okay, here we have a series of upper shadows. Okay, and I circled in blue a series of upper shadows to show, gasp, it doesn't always work. You know, this is the real world. It's not going to be 100%. There's a wonderful Japanese proverb, you may have heard me say it before, it's just so great. The Japanese say even monkeys fall from trees. Okay, nothing is 100%, not even the candles. You know, here the upper shadows worked fine in the red, and the blue it didn't work. And that's why we always have to talk about stops. And when we talk about money management, we will talk about stops. Yes?
At that point, at the blue circle, where your shadows did not work, could you have used the breakout as a continuation of the long trend?
Okay, the question is, the blue circle here where the shadows did not work, could you use the breakout as a continuation? So what she's saying is the breakout here as a continuation. Normally, I would say yes, and actually, let's look at this here. Then the question you have to ask yourself, is this enough of a breakout? Okay, I would probably say no. All right, I would like to see more of a breakout than that. But normally, if it does close above it decisively, maybe 20 pips or something, depending on the market, I would then say it was a bullish breakout. Now, I had mentioned before that single shadows aren't normally important. The exception is the hammer, which we'll look at now, and the shooting star. And the hammer is a bottom reversal signal. And this is the same in Forex and non-Forex. And these are your criteria. The hammer and the next one we'll be looking at, the bearish counterpart, the shooting star, are called one-sided candles, one-sided shadows, because the shadows appears on one side of the real body. So the hammer is a very long lower shadow candle. The real body can be black or white. The main thing is we want that lower shadow at least twice or 3 times longer than the real body. We visually want to see the market rejecting lower levels. The Japanese say the market's trying to hammer out a base. The actual Japanese word, and I don't speak Japanese. I wish I did. I could have saved a lot of money. I paid all the translations. I mean, before I did the book, I laid out all the money myself for the translations. I had no idea that the candles would become so popular. It was working so well for me when I was doing the trade recommendations. I figured, what the heck, even if I was the only one to use it. But the actual Japanese word is takuri, Takuri. And I'm sure I'm pronouncing it wrong. But my translator told me that it means that you're in a river and that you're feeling for where the mud is. You're trying to grope for the bottom. That's a great analogy. The Japanese are so wonderful with their metaphors and their analogy. And that's what we're trying to do, see where the bottom, where the low of the market is. So this is a hammer. And by the way, it can have a little bit of an upper shadow. Whoops. And if you want a kind of a definition, it would be 10% of the lower shadow. And the reason I can give you some of these specifics is because I have some candlestick recognition software. And it'll be out probably in the next month or so. By the time the DVD's out, it'll be out. But it's really neat. It's the only... How many of you have candlestick recognition on your computer? None of them have my input. I bet you they even forget about the trend. I bet they call a bearish engulfing pattern if it comes there. Or we'll look at this later. They don't talk about trend. I'm going to have software that's going to have candlestick recognition, and it's going to allow you to filter through any markets, Forex, stocks, you name it. You could have your whole portfolio, you could Russell 3000, all the crosses, all the pairs, pick out all of them that have bearish engulfing patterns or a hammer and are above a 200-day moving average and have the RSI below 20%. And it'll give you all the symbols for that. You could have a chart on the screen, highlight all the candlestick signals. It'll highlight all the candlestick signals. It'll also do a real-time intraday. Pick out all the Forex markets, all the equity markets. I think it limits to 200 real-time that are currently building a hammer. So the reason I mention that is because I had to think in concrete terms, how much is too long an upper shadow? I never had to think about that before. Yes?
On that hammer, how often, or what's the probability that that's a good signal that the market's going to go?
Okay, the question is how likely is it's a good signal? This brings us back to increasing the probabilities of a trade. Okay. If this hammer confirms a support area, the probability is higher. If, and we're going to look at this later, this is very common. I most often see the lower shadow of the hammer tested. It's rare to have the market sell off, have a hammer, and just rally without coming back into the lower shadow. So one strategy to think about is wait until it gets into the lower shadow, anywhere from the half part, and this is not 100%, but this is from my experience, anywhere from the half to the bottom of the lower shadow. And this is, see this bit of an upper shadow? That's fine. So I've found that She quite got to it, but the shooting star should be a resistance area. Yes.
32, please.
What's that? 32?
Yeah.
Okay.
What is the support level for the after doji? Yeah.
Up here?
No, down there. Yeah.
Down? Over here?
The hammer.
Okay.
Yeah.
Okay, the question is, what is the support area of the hammer? The low of the hammer should be a support area. Okay, if the market closed under it, okay, so for example, here we have a spinning top and a doji. Did the doji and spinning tops hold as resistance? You always should use the candles. You can always use the candles to set stop-out levels. So the doji here and the spinning top, did it hold as resistance? Over here? Yeah. Set a resistance area here. Sure it did, right? And once the market got above it, that's a bullish breakout. But this trade probably would have worked out because if you're selling it here, what's your potential target? The recent lows, right? Yeah, it's hard to see the number. Right, but the lows, I don't want to use a laser pointer, but it would be the lows over here.
Yeah.
Right? So, although the market ultimately did break the doji's resistance, pulled back, okay, so it would have met your target, so that would have worked out okay. But the point here is, once again, emphasizing the importance of using candles as potential stop-out levels. So the low of the hammer should be a support area, and the high of the shooting star should be resistance. So as we move on. Now, what we're looking at now is a combination of kind of a shooting star and a hammer. The hammer has a very long lower shadow. The shooting star has a very long upper shadow. This is called a high wave candle, and what it is a candle line made of a long upper and lower shadows. And what that means is that the market rallies. By the end of the session, the market pulls back. It sold off. Remember, lower shadow means it sells off by the end of the session, because if there wasn't a lower shadow, if the market was weak, it should close as a black real body, right? So long lower shadow means the market sold off, rallied. The long upper shadow means the market rallied and then sold off. It's totally confused. A high wave candle, the reason I have this slide, the waves of an ocean, the Japanese compare it to the waves of an ocean. The market is really confused. It's totally confused. It goes up, it goes down, it doesn't know what it wants to do. And the Japanese have a wonderful proverb about somebody being confused. Let me see if I remember it. As if his hair is set on fire. Very visual, running around going, oh. So the high wave candle is telling us that what we do is look at the high wave candle compared to the prior candle. So for example, did the euro here have a sense of direction? Sure. Sure did. Okay. Here, it's most of the time the high wave candles also have small real bodies. So the small real body is showing us the market could be losing momentum, but these long upper and lower shadows are also showing the market's confused. What does that mean? It means the trend has gone from up to neutral. It's gone from a period where the market knew what it wanted to do, to a time where it doesn't know what it wants to do. What does that do to the probability of the market's turning? It increases, right. It's not 100%, but it increases it. But with this, as soon as we have this spinning top, which is the same as a doji, we set that as a resistance area. Okay. Now we have a couple of couple of high wave candles here and over here, and we're going to look at these later because I'm going to go over why this why this high wave candle did not call a bottom, whereas this high wave candle did. We're going to look at oscillators later, combining Western technicals with candles. What we're focusing on in this portion is just candles. But we want the odds in our favor. How do we do that? By adding Western technicals. I tell people candlesticks are a tool, they're not a system. And by adding them, merging them to Western technicals, we're going to dramatically increase the probability of the candles working out. Okay, the next topic we're going to be looking at is, and a lot of this stuff is not in my books, including this one, or my Nissen trading principles, or the candlestick screener we'll be looking at later, is not really a candlestick pattern, but we're going to be using the candles to see how the market reacts as compared to how we think it should react. So let me go through this. A picture's worth 1,000 words, so don't worry about the understanding what the text is. When you see it, it'll be a lot easier. A bearish checkmate. That's when we have a series of white candles, because that shows us the bulls are in control. We have a series of white candles followed by black or small real bodies near the same resistance area. And what it's actually showing us is that the bulls can't maintain control of the market. The rally is being checkmated. The bullish checkmate is the opposite. Black real body and then no follow-through to the downside. So let's look. Case in point. Long black real body, bears are happy. Little smiley face. Okay. Now, with that long black real body, what would we expect to happen? The market to continue weaker, right? Strong bearish momentum. I know if I was bearish, I would be, especially with those two prior black candles. But look what happened in the next session. No follow through. The bears are getting a little unhappy here. No big deal. Okay. Next session, bears are in control. It's still holding support, but it's a new low close for the move. Bears are getting a little bit more optimistic. What happened in the next session? No follow-through. And don't worry about if there's any candlestick signals or not here. That's not important. What the aspect of this that I want to focus on is that the candles are showing us that the bears are in control. There's no follow-through to the downside. The bears are in control. There's no follow-through to the downside. And if this happens 2, 3, 4 times, the bears are going to throw their hands up in frustration and say, okay, I'm getting out here. So this would be a bullish checkmate. Okay? So essentially, the definition is, again, long black real bodies or black real bodies, and then next session, and this doesn't matter what this is. It could be a doji, just something to show us that the bulls have lost control of the market. If it happens one time, it's no big deal. But 2, 3, 4 times, certainly something to take notice of. The same thing on the upside. If we have a long white candle, we would think, the way I like to conceptualize it is like a long white candle is like a broad jump. You're taking a running jump and you're jumping off. You'd think you're going to continue going higher. And the next session, if there's no follow-through, no big deal. But then if you have another white candle right at the resistance area, the bulls are getting a little bit more optimistic again, no follow-through. I wouldn't use that to short, but I would scale back on long positions, just like I would scale back here on short positions. Same thing here. I'll show you. Another weak market, no follow-through to the downside. Okay. And by the way, this is that slide shown just extended back. This is that the checkmate area that I showed you in the prior slide, the bullish checkmate. And you can see the same thing happened again. This is a daily chart. You can see the same thing happened again a month or so later. The bears are happy, and a little smiley face there on the black candle. No follow-through. Some of you may recognize this as a bullish engulfing pattern, but that's not important. Same thing, another black candle and no follow-through. So for whatever reason, the bears just can't hold control of the market as the market gets down to those levels. Oh, that red semicircle, and I alluded to it before, is when a white candle wraps around a black candle. This is called a bullish engulfing pattern.